Good evening, everyone. Would like to welcome everybody to this meeting with respect to the rate adjustment proposal put forward from the Saskatchewan Auto Fund, which is administered by SGI. My name is Albert Johnston. I'm the chair of the Saskatchewan Rate Review Panel. Our panel consists of 7 persons from Saskatchewan, and just so you know, they are as follows. Delane Barber from Weyburn, Dwayne Hayunga from Prince Albert, Glenn Duchak from Kenora, Kim Hartle from Lake Lenore, Bonnie Guillou from Saskatoon, and Keith Moen from Saskatoon. The rate review panel is appointed by the government to review rate applications from the 3 crowns in Saskatchewan, Sask Power, Sask Energy, and the Saskatchewan Auto Fund. Part of our mandate as part of a rate review is to seek public input, which will usually include some form of public meeting. In the past, we have held in-person meetings for these, but as technology has evolved, we have been using virtual meetings or a combination of in-person and virtual meetings. The main advantage of this meeting, that form of meeting, is that anyone from across the whole province can participate without driving perhaps many miles from either Saskatoon or Regina. The format for tonight's meeting will be, we'll start with a presentation by SGI regarding the background to the rate process and the results that they have come up with in their proposal. Anyone attending online may at any time post questions using the Q&A section on the screen that you're looking at. If you wish to comment or pose a question, simply find the small icon near the top with a question mark in it. Click on it and a window will appear, I think on the right side of your screen, and from there you can type in a question and it'll show up here, and I will read them out and get questions or comments from SGI. As you might expect, we would ask that you would keep your questions and comments appropriate. Any sort of abusive language will not be tolerated. So with that, I will now turn it over to Jeff Steppen. Jeff is Executive Vice President, and Chief Financial Officer at SGI. Jeff will then introduce at least one other person I know that will participate in the presentation process. So with that, I'll turn it over to Jeff.
Thanks very much, Al. As Al mentioned, I'm Jeff Steppen, SGI's Chief Financial Officer, and I'm going to be sharing the presentation duties tonight with Chris McCullough, who is our corporate actuary. And also in the background, we have a few other SGI officials who will introduce themselves if they get called on to respond to a specific question. So Chris is going to talk about the rating process and the results of this application, and I'll be discussing the Auto Fund's mandate, review the financial results, and talk about the level of our reserves. So Chris, if you want to move ahead one more, please. The mandate for the Auto Fund is to break even over time. So that is to collect enough revenue to cover claim and administrative expenses, as well as to maintain adequate reserves. The other key mandate for the Auto Fund is really to ensure fairness in rates, and that's to ensure that each class of vehicle is paying enough in premiums to cover their claims and expenses, not too much, not too little. We don't want any cross-subsidization. And very importantly, this is a public fund for motorists. The government has put no money into the Auto Fund, and they cannot take any funds out of the Auto Fund. Right now, the Auto Fund is collecting enough premium overall, hence the net 0% rate application, but individual vehicle classes are not all well aligned with their adequate rate, and that's why you see the increases for some vehicles and decreases for other vehicles, and they're going to offset to get us to that net 0% change overall. So in terms of the rate proposal overview, there's 2 big components to the rates. We have an amount to cover claim costs and expenses, and that's the base rate. And then we also have an amount to ensure that the auto fund has sufficient capital in the rate stabilization reserve, and that's the capital amount. So overall, claim costs have been increasing for the auto fund, so the base rate has to increase by 1.7% to offset those increased costs. And Chris is going to go into detail on this. However, we have sufficient capital in the rate stabilization reserve, so we can reduce the capital amount that's currently built into rates by 1.6%, and I'm going to speak to that in a few minutes. So when you combine the two, the increase to cover claim costs, the decrease because we can reduce for the capital amount, plus a little bit of rounding, those two offset to get us to the 0%. Couple of key principles that the auto fund operates under. First of all, providing basic insurance that's universal. So that means it's consistent, it's comprehensive coverage for all customers, and it's fair. So that means all customers are treated the same. We also want to fairly rate vehicle classes based on how many at-fault claims the class has had in the past, which indicates what it might look like in the future, and then how much we expect it to cost to deal with those claims in the future. And the last point is an important one, and that's to keep rates as low as possible. The stated goal for the auto fund in its balanced scorecard is to be among the lowest two rates in all Canadian jurisdictions. Right now, we're the lowest. And then when you think about it, given the operating philosophy that this is a public fund for motorists, there's really little incentive to generate huge profits in the auto fund. The insurance coverage for the auto fund is defined in the Automobile Accident Insurance Act. That's the act that governs how we operate. There's three big parts to the insurance coverage that it's provided. We provide personal injury benefits, and that means that anyone who's injured in an automobile accident will be taken care of. For customers who choose no fault coverage, that means income replacement benefits, medical costs, rehab costs, so that's physio or chiropractic, medical devices, and even home modifications. There's also a tort option, which allows the party who's not at fault to sue the at-fault party in the accident for damages. There's also third-party liability, and what this is allows to it covers the at-fault driver for the cost of injury or damage to others' property. And then, of course, we have the physical damage coverage, which covers any physical damage to the vehicle, or if it's totaled, it provides funds for a replacement vehicle. I'm going to spend a few minutes now talking about the results for the auto fund. This next slide shows the financial results, so the income statement for the last 5 years, and the auto fund has a March 31st year end. So we're looking at the period from April 1st, for example, in the first column, April 1st, 2016 to March 31st, 2017. In the top line there, it shows the net premiums earned, and you can see that that's around $1 billion, or just shy, between 900 million and $1 billion, and you can see that that's been fairly flat over the last 5 years. The next line is total claims and expenses. So this is our costs to cover all the types of claims that I just talked about, plus the administrative expenses to run the auto fund. And you can see that in all cases, the total claims and expenses are greater than the premiums that we bring in. So we're actually, on purpose, we're creating what's called an underwriting loss. And we do that knowing that we're going to have some investment income to offset that. And we also have some other income like salvage sales. So again, the mandate is to break even, but given the volatility in claim costs, given the volatility in investment income, we're not going to get that right every year. And if you look at the bottom line increase or decrease to the rate stabilization reserve, in 4 of the last 5 years, we've made money. We've had an increase to the rate stabilization reserve, and in one of those years we had a decrease. Now, importantly, that rate stabilization reserve is there. It's held there for motorists, so that when we have a period of where we're drawing from the rate stabilization reserve, we can do that and not have to go and increase rates quickly to compensate for the loss that we experienced. So it's a buffer to allow for some stability in rates, hence the rate stabilization reserve. Yeah, I think I'll leave it at that, and we'll talk a little bit about some of the significant changes. So we had a very good year in 2021. We had a net income of $283 million, and that allowed us to make some significant enhancements to injury benefits. So we have increased amounts for living assistance benefits, and this allowed us to increase the maximum weekly benefit for things such as dressing, bathing, cooking, cleaning, yard care, and this is for our most seriously injured customers. And we also were able to enhance the income replacement benefits. So the standard practice in the industry is to reduce the amount of benefits that a person is receiving by the amount that they get from Canada Pension Plan. So we stopped doing that offset, which allowed greater income replacement benefits for our customers. And as I'm sure you're aware, we also, with the strong results, were able to provide a rebate to all policyholders, a $285 million rebate that amounts to about 26% of the annual average rebate or annual average premium that customers paid in the last 3 years. I talked a little bit about the need for the rate stabilization reserve. So in addition to protecting customers from sudden large rate increases, it also ensures that the auto fund can meet its claim obligations. As I noted, in some cases, we're taking care of injured customers for the rest of their lives. So we're looking out potentially 50 years or more, and lots can change in that time. So we need to make sure we have an adequate buffer in case the reserve estimates are off. Back in 2014, we didn't have enough in the rate stabilization reserve, so 2.2% was added to rates to slowly build up capital. And now that we have enough in the rate stabilization reserve, we can reduce that capital amount. Why don't we reduce that rate to zero? In the slide that's showing up right now, SGI just doesn't get to decide how much money stays in the RSR. There's industry standards and models that are used to calculate and determine how much capital would be appropriate to hold. The insurance industry uses a measure that's called the minimum capital test that calculates the level of capital that's being held by looking at the riskiness of liabilities, and the more risky the liabilities, the higher the level of capital that's needed. And it also looks at the riskiness of the assets that are backing those liabilities, and the safer the assets, the lower the extra capital that's needed. The auto fund's current target is an MCT of 140, and that number is not going to mean much right now, but it'll start to make sense on the next slide when I get to that. So as defined in our capital management policy, there's two parts to the capital margin that gets built into rates. We have what's called the capital maintenance, and even though premiums haven't been increasing much, the auto fund's liabilities continue to grow as new customers are unfortunately added to claims, or injured and added to claims, without the old customers dropping off. So our liability balance is growing. And as the liabilities grow, so too does the reserve, and the buffer backing those liabilities has to grow. So that's the maintenance part. We also have what's called the capital build or release, and this is an amount that's designed to move the RSR closer to target, either up or down slowly over time. What we're looking at right now is that we have more capital than we need, so we're reducing rates by 2.9% to cover that. but we need rates to increase by 3.4% to ensure that the auto fund's capital is increasing enough to offset the natural growth in the business. So when you take the 3.4 less the 2.9, that's how we get to the 0.6. And just to take it one step further, the current capital amount that's built into rates is 2.2%. We only need 0.6, so that allows us to reduce the rates by 1.6, and that's what I talked about at the beginning of my presentation. On the next slide, and this is my last slide, this shows the level of capital over time. The red line is the 140 MCT that I talked about, so that's our current target. The blue line is where we've been with our actual level of capital over time. And you can see back in 2005, 2006, 2007, we were in much the same position that we're in now with a little bit extra capital. But you look how quickly that can change. We had a correction or a crash in the investment markets that reduced capital in 2008, 2009. That happened again in 2011. In 2014, we dealt with the low level of capital by putting that 2.2% into rates, and that got slowly built up over time to the point now where we have, again, we're in a position with a little bit of extra capital. We rebated $285 million to bring our capital down. We're still high, so that allows us to reduce the capital levels a little bit by 1.6%, and that will bring us down to, over time, closer to our target levels. So I'm going to stop there. I'll turn it over to Chris, who's going to talk about the rating process and the results of the analysis.
All right, thank you, Jeff. As the actuary for the auto fund, my main role is to measure how much the auto fund needs to charge to be expecting to break even against its claims and expenses. So there's three major components to the rate application we've got up on here. First off, measuring that overall level of adequate premiums to expect to break even. Second, making sure there's fairness in the rating, which means each individual vehicle in the auto fund paying a rate that's equivalent for its level of risk. And finally, maintaining adequate capital in the auto fund. So Jeff's spoken mainly to that capital point. I'm going to cover off the first two in a bit more detail on my slides here. So that overall indicated rate increase of 1.7% that Jeff's mentioned, it comes from a number of factors, and I've highlighted some of the major ones here. First off, we are seeing improving overall injury claims experience, which actually reduces how much we need to collect, but is being more than offset by rising overall damage costs and increases to the expenses. And as Jeff mentioned, that overall 1.7% is of course offset by the reduction in the capital margin, making it an overall net revenue neutral rate application here today. So I'm going to dig in a bit on what it means when we say improving overall injury claims experience. And this is on an overall basis, right? So this will vary based on individual classes of vehicles, which I'll speak to in a bit more detail later on. But on an overall level, what we saw back in the 2014 rate application was the trends on the left for these different types of injury coverage. Medical benefits, income replacement benefits, and death benefits were increasing year over year by 4% or more. Care benefits, or living assistance as they're called, were generally quite flat over time. And there's been a complete turnaround since that rate program for today. Now, income replacement benefits and death benefits are declining year over year, the total amount that we're paying out in claims by 4 to 5%. Medical benefits have flattened out, and care or living assistance benefits have started to decline. There's a variety of factors this can be attributed to. There's been a number of traffic safety initiatives implemented by the Auto Fund. There's been a lot more focus on impaired driving, including both enforcement of that as well as some new laws. And finally, new safety features in vehicles in newer model years. The most important thing here is that this means fewer people getting injured or dying in car crashes every year, which has an amazing impact on their lives and the lives of their families. In terms of the Auto Fund specifically, it means reduced costs, which translates to reduced premium needed to be charged for its customers. On the other side, though, offsetting that is worsening damage claims experience. And the main driver behind this is rising overall repair costs. We're seeing more and more complex technology, procedures to repair, and materials used in newer vehicles, those same safety features that are contributing to reduced injuries are a lot more expensive to repair in vehicles. Something that used to be a very minor accident where only the bumper needed to be replaced is now a lot more intensive when it has a bumper full of sensors that need to be reattached and calibrated. When we look at repairs that are 5 or 6 years ago, they used to cost significantly less. What we have on the screen here is the overall private passenger vehicle collision cost per crash. And 5 to 6 years ago, that used to be less than $4,000 per crash, and now it's well over $5,000. So this increase that we've seen since then is over the level of inflation is over that point in time, and it's consistent, as you can see. So as these costs go up, so too does the premium that the auto fund needs to charge to offset them. I want to speak a bit to the COVID-19 pandemic and the effect that it's had on claims that we've been seeing since it started in March 2020. The auto fund has seen fewer claims over that period, but not in a uniform or even way over time. During periods of significant restrictions are in place, we saw noticeably fewer claims. But when those same restrictions were relaxed, we saw the claims return back up toward a more normal level. The effect on this is fading now, today, and we expect claims to return to an approximately pre-pandemic level by 2022, which is the rating year for this rate application. The one exception is commercial vehicle classes that might take longer to recover from the economic impact of the pandemic. What we've assumed for them, given what we've seen in the past, is a reduced volume of vehicles being registered, about 5%. And that'll affect the premium and claims that we forecast for those groups into the rating year. So I've spoken mainly to the first overall major piece of the rate indication work, answering that question of how much overall premium or revenue is needed to offset claims and expenses. The next question is, how do we take that and determine individual vehicle rates? And it's no small feat. There's over 30 classes of vehicles in the auto fund, and each vehicle class's rates depend on specific characteristics to those vehicles. One characteristic, such as number of seats, might make sense for buses, where we've seen that it does directly correlate to the cost of claims for repairing or the overall average damage that a bus will sustain, whereas that makes no sense at all as a variable for motorcycles. For motorcycles, it could be something unique, such as engine size, which we've seen correlates to the severity of injuries we tend to see. Now, we don't want to change individual vehicle rates too much in a single year, and so we propose a rate capping process. So the schedule being proposed for this rate application is the one on the screen here. For most vehicles, what it means is a maximum 15% overall increase or decrease, and that's for vehicles with current premium over $1,000. Other vehicles would have a dollar cap, depending on their current annual rate. Right now, today, only 21% of vehicle rates in the auto fund are close to paying their correct level for their level of risk. And that's the effect of not having a full rate application since 2014 to adjust the rates. With the proposed rate changes in this rate application, along with this capping schedule here, we expect to get 93% of vehicle rates at that correct level. I want to jump in and highlight a few vehicle classes that are still a bit far from paying that adequate level of premiums. You can see here motorcycles, motorhomes, and taxis are all 70% or more of their vehicles still not quite there, even after this rate program. Personal trailers are over 40% still off from paying enough. And to contrast all of that, private passenger vehicles, our largest group, are pretty much there. Over 95% of them are paying their adequate rate. I'm going to dig in a bit on some individual vehicle classes now and talk about their indication and the changes that have happened since the last rate application. Motorcycles require a 34% rate increase to break even between the premiums we collect from the group and the claims and expenses seen for them. After the effect of that capping that I just spoke about there, it's proposed to be a 10% rate increase. What that means is 88% of motorcycle rates increasing and 12% of them decreasing. Now, motorcycles needed over 70% rate increase back in 2012. And since that time, that rate need has been brought down through some rate increases as well as some initiatives that went in place in 2014. Additionally, there's also a new option that's been put in place since the last rate application to allow motorcyclists to elect a reduced level of no-fault coverage in exchange for a discount applied to the rate that's charged. In this rate program, we're not proposing any changes to those discount levels, but we are further refining the engine size and model year grouping categories so that the rate charged for a specific motorcycle better reflects its specific risk, as opposed to the risk of the motorcycle that happens to be in that group with. In the history of motorcycles, we've unfortunately seen that the claims have tended to exceed the premiums, claims being the blue bars here and the premium as this orange line. This graph also doesn't even include expenses, so in order to break even, the orange line would have to consistently be above the blue bars. You can see there was a couple years recently, 2016 and 2017, where motorcycle experience was close to breaking even, but since then, the trend on premium has been to decline and the claim costs are growing. So while we have seen some success with other measures and initiatives put in place for the motorcycle class, we're now at a point where we believe that raising rates needs to be at least part of the solution to aligning their premiums with the claims and expenses going forward. Speaking to another group in the auto fund, permits. They're a very short-term registration option for vehicles, generally either 24-hour or 8-day time periods. And this is the first time an actuarial indication has been performed for permit rates. They haven't changed in over 20 years. The increases we have proposed here are to better align the premium with the claims risk we've seen over that time period. So we have 24-hour permits rising from $20 to $26, while 8-day permits are rising from $48 to $73 each. Taxis need a 38% rate increase. After the effective capping, that's a 13% increase proposed. This rate need is not new for taxis, unfortunately. They needed 30 to 40% in each of the 2012 to 2014 rate programs. Back in 2013, SGI worked with taxi companies and other stakeholders as part of a review of the business recognition program that they all participate in. And as part of that review, a number of changes came forward to help address some issues. The maximum discount was increased from 10 to 15%, and the maximum surcharge was reduced down to 25%. Additionally, some changes were made to even the playing field between individuals and companies in the program, which was a specific issue for some taxi stakeholders who participated in that process. A new group in the auto fund since the last rate application are transportation network companies. Because of their unique nature, rideshare companies needed a different rating structure from other vehicles. They're rated based on the number of kilometers driven because of how different that usage looks between different vehicles inside the class. For example, one rideshare vehicle may operate every day of the week and have a risk profile very similar to that of a taxi, whereas another may only operate one night a week and its risk is very, very different. The rate we've initially set up for these transportation network company vehicles is 11 cents per kilometer, which applies only when the vehicle is participating in ride sharing. And that rate is not proposed to change in this application. That rate was initially determined using the adequate taxi rates, which are higher than both the current and proposed level of taxi rates. If we were using the taxi rates currently, which still need this rate increase that we've been talking about here, the transportation network companies would have only been charged 8 cents per kilometer. Motorhomes are another group with a significant rate need. They require a 135% rate increase. And after capping, that was proposed to be a 20% rate increase. Now, this rate need has been building every year since 2014. What we've seen is very strong growth in the number of rodent infestation claims, as well as the cost required to clean up for them. There's a lot of concern over the viruses carried by those rodents, and we're not the only province also dealing with this issue. The last group I'm going to speak to are light vehicles. So this is private passenger vehicles, and I hadn't really spoken to them yet. The rate for a specific private passenger vehicle depends on the experience seen in Saskatchewan for that vehicle, as well as by insurers all across Canada. We use information from those insurers to help supplement our own data where we don't have enough for a specific vehicle. Overall, private passenger vehicles are proposed to get a 1% rate decrease, but the key here is that it varies for each vehicle. I've got some examples of popular Saskatchewan vehicles on the screen here. You can see the 2010 Dodge Grand Caravan, the 2008 Honda Civic, and the 2007 Toyota Camry are all posed to get decreases, in some cases significant ones. The 2018 Chevrolet Silverado and the 2018 Ford F-150, on the other hand, are slated to increase. Other vehicles may have a smaller or no rate change at all. We have a PDF on our website that shows the rate change for each make, model, and model year of vehicle in the auto fund, so you can go look up yours there. Finally, as Jeff mentioned, one of the important SGI operating philosophies is to keep rates as low as possible. And this rate program, as mentioned, has a 0% proposed rate change toward this. You can compare our history of rate changes to the increases seen under the inflation index CPI. Since 1999, CPI has risen by over 50%, but the cumulative rate changes the auto fund have taken have been 7%. It's just one measure of how we're trying to keep rates as affordable as possible for Saskatchewan residents. So I hope this sheds some light on the reasons for the rate changes that are proposed and included in the application that's before the panel today. Thank you.
Okay, thank you, Jeff and Chris, for that information. As I mentioned, there are the opportunity you have to ask some questions. I don't know if there are any on there. I'm just opening it up myself to see if there's any questions that have come in. At the moment, there are none, so I would encourage any of the attendees to ask any questions. This is your opportunity to find out answers to any of your questions related to automobile insurance rates, and in particular, the proposed changes that SGI has made in this rate application. Maybe I can just ask one quick question that I thought of as you were going through this, Chris. The permits are a variable amount, I assume, depending on the type of vehicle that is being permitted. Where do you know what's on the low end, what's on the high end of that range?
All right, yeah, thank you for the question, Al, here. So right now, permit rates are actually fixed. So those rates that I listed there for the 24-hour and 8-day permits are charged regardless of the vehicle. Now, being able to adjust the rate for the type of vehicle registered, as you mentioned, makes a lot of sense, and it is something that's on our list of things that we're evaluating. And there's a number of system changes that be required for that kind of thing, but it is on our list. There's currently a bit of a transformational process right now, reviewing our systems in place. And as part of that changes, we do intend for these types of things to be a lot more flexible in the future, gentlemen.
Okay, thank you. Well, I don't see any questions that have come in from any of the attendees. Maybe we'll just hang tough for a couple of minutes here to make sure we've given people an opportunity to ask any questions, and maybe I'll just make a few comments. The panel will be using the results from these public meetings. We've been going through the rate application itself. Our consultants that we've hired, both a financial consultant and an actuarial consultant, have been going through this. We have received answers to a number of questions that have been posed to the auto fund, to SGI, and as a result, we will be doing all of this work over the next few months. Our final report is due to the minister on October 20th. So at that point, our final recommendations will become available to the public, and we will be making an announcement at that time, and you'll be able to go on to the Saskatchewan Rate Review Panel website and have a look at that. So are these questions, are there questions there? Okay, sorry. It says, as motorcycle insurance rates go up, fewer people will ride. Why not drop rates so more people ride and you get more money to pay for claims?
I can take that one.
Okay.
It's likely true that as you drop rates, you will make it more affordable potentially for some new riders to be introduced. The problem with that is any new riders will also attract new claims. Right now, we're not covering existing claims, so we're operating at a loss. By lowering rates and more people coming in, that loss just gets magnified. Even though the pool of premiums will increase, so will the losses. Just statistically speaking, those losses will be there.
Thank you. Another question has come in. Which class has the best not at fault I guess he's saying the best not at fault claims. And I'm assuming, you know, we're talking about passenger cars, SUVs, trucks, motorcycles, taxis, whatever. What class actually has the best rating?
All right. Well, we may not have a detailed statistics on every individual class's fault percentage, but we do have some interesting information about fault statistics for some different groups. Private passenger vehicles tending to be at around 50%. And then we have some information in the filing on motorcycles and taxis. And while I can't exactly remember what those percentages are right now, they are available in that public filing that we put on the SRP's website. I do recall that motorcycles specifically do have a percentage that is below 50% at this time.
So they have the best being, or they they have the best rating is not at fault.
No, we don't
well,
have.
Who has the best, I guess, is the question.
We haven't looked at it for all classes of vehicles, so we don't know at this time exactly who the best is in terms of their fault statistics.
Okay. Are rate decreases capped at 15% as well as increases?
That's right. For that rate capping schedule that I posted there, it would be applied for both increases and decreases. So 15% would apply to any vehicles that have $1,000 premium or greater today.
Okay, thank you. Okay, any more questions out there?
Looking up a bit more detail just while we're waiting for additional stats here. Out of the three that we do have in the filing initially for at-fault statistics, private passenger vehicles, motorcycles, and taxis, out of those three groups, taxi is the best, having at fault only 34% of the time.
Yeah, actually the person that posted that question says, yeah, 66% for taxis is the best.
Right.
I guess that's a function of that you got professional drivers who are doing it every day on perhaps not the best road conditions all the time. So. Okay. Anything further? I guess I would just point out another couple of things while we're waiting to see if there's further questions. This is part of the public input process that the panel uses to gauge public concerns. We also received a lot of input from the public through our website commentaries. We've received a lot of emails and phone calls, something in excess of 200. So we are getting a lot of input from the public. The cutoff, and it's not a hard cutoff, but a soft cutoff for public presentations to the panel is August 29th. So you have another month in which you can make your views known to the panel, and you can certainly do that by going to our website and giving a response to the feedback section of our website. So I encourage anybody that has other questions or concerns or comments they want to make to go to our website, which for your benefit is just saskratereview.ca. So that is available to you at any time. And I guess I just answered that question. Will there be an opportunity to present information to the panel? And the answer is yes. Now you have another month, and if you want to reach out to us through our website, and if you wanted to make an in-person or some sort of call to us, we'd be interested in hearing from you. I'm not sure what this question means. It says, so that is why you put rates up 5,000, great incentive. I don't know what that means, but I believe this is in relation to taxis. Would whoever put that comment, would you expand on it so we understand the question and reply? maybe in the meantime, there's a question that says no rate increase for TNCs. Maybe could you just address that, Chris, as to the reasoning for that at this point?
Absolutely, sure. Yeah. Yeah, the initial rate that was set up for transportation network companies is still quite a new rate. And while they have been operating for just over a year in the province here, we don't have enough data yet to make an informed, credible change to that rate. We are starting to collect that information, and we'll accumulate it as we collect more, and we'll be revising that rate in the future if it shows that it needs to be different. But as it stands right now, it was priced to be an adequate rate, and so we wouldn't anticipate any change in it up or down until the data shows otherwise.
So it's something that you monitor on a regular basis, and if there is a rate adjustment to be made, it will happen probably in the next year or two.
It would form part of the analysis for future rate applications.
Yeah,
That's correct.
Okay. Okay, thanks. Okay, I don't see anything else coming in, but well, maybe we can close it off here. Again, I want to thank SGI for making their presentation and being available to answer the questions that did come in. I want to also acknowledge and thank the people that logged in and watched the presentation. And as I say, you still have a month or so to make any additional comments or presentations to the panel. We'd be very, very interested in hearing from you. So I think with that, unless there's one more here. Says yes, this for taxis going up over $500. I'm not entirely so that is why you put up rates up $500. Great incentive. Yes, this for taxis going up over $500. I'm not sure. Maybe Chris, you can read between the lines better than me as to what that is getting at there.
I think I can take a stab at it. Yes, I think it's contrasting the fact that taxis have quite a low at-fault rate for their claims that they're involved in, yet at the same time we're increasing the rates for them, and that those two seeming to not be very consistent with each other. The issue is that even though they are at fault for a smaller number of those collisions, the total volume of those collisions is still significant enough that the total claims and expenses that we're seeing associated with those collisions is exceeding the total amount that premiums are paying at the time. So while they may have fewer percentage of their claims be at their own fault, that it still is unfortunately enough that that increase is needed to align the premiums with the claims for the group.
So the 34% of times where they are at fault is still significant for that group. You're not charging the taxi group with accidents where they're not at fault.
Correct. Whenever another vehicle is at fault, like a private passenger vehicle, is at fault for a claim involving it and the taxi, all the costs from that accident, the damage from both vehicles, any injury costs from people who were in those vehicles, all of that would be charged to the at-fault group in that example, the private passenger vehicle class.
Okay. And has the total cost, claims cost for taxis been going up over the years?
Yes. Unfortunately, each year their rate need gets a bit worse, and it's pretty consistent over time.
Okay. And this is a comment. It says, won't increase in taxi rates, but not in TNC rates. Drivers will leave the taxi industries and go to TNCs. I guess that's a potential consequence of the differential. And I don't know if there is actually a differential overall, but maybe you could comment on that, Chris.
Sure. Since the transportation network company rate was set up to be a fully adequate rate, that because of that, there would be potential right now that those drivers are actually paying more on a per kilometer basis for their insurance than taxis are right now. So in a sense, at least from the insurance point of view, the increase to the taxi rates while maintaining the transportation network company rates actually moves them toward alignment from where they are today.
Yeah. Okay. And the last question I have here, maybe not the last one, but another question that says, how often will rates be reviewed in the future? And I think that's a general question. maybe I can just comment that this is the first rate application from SGI, from the Auto Fund, in 7 years, so it's been probably way too long. That is controlled by the government. They make the decision as to when rate applications go forward. So I guess, as chair of the panel, I'm hopeful that we will see more frequent rate applications so that any adjustments typically aren't as large, and that they are gradual over a period of time. But I can't predict that. We don't have any control over that, and nor does SGI. So I think I'm right on that, Jeff, right?
Yes, you are, Al. Part of the decision that went forward was to have annual rate applications. We do an indication every year, and we're hopeful, as are you, that we're able to do this on an annual basis now going forward.
Good. Okay, we'll hang on for a minute to see if any further questions come in. Okay, well, I think maybe seeing no further questions, we'll adjourn the meeting. And again, thanks everybody for tuning in. And we will look forward to seeing our final report in October, and we'll see what recommendations we're able to make with respect to all of the rate applications. Thank you very much. Good night.
Thank you. Bye-bye.